Why don't we start off with that last bit from Deutsche Bank, the potential decline in the dollar if this were to happen, and also the spike in yields. Do you see a similar setup? And I do think it's important to note that while a lot of this talk has gone on, we've actually seen the dollar move higher, up about 0.5% over the last week.
Yeah, absolutely. The dollar has rebounded a bit in the last couple of weeks, but I think fundamentally the administration seemed to be a little bit like a dog with a bone with this idea of trying to force Jay Powell out of office. And I think the guys over at Deutsche have probably hit the nail on the head in terms of the market reaction. You'd see some really significant outflows from the dollar in knee-jerk fashion, but also more sustained over a period of time. And you'd see a big spike in yields at the long end of the curve, which would naturally cause quite a significant steepening as the front end rallies on the prospect of a more dovish policy outlook. But of course, that more dovish outlook would likely lead to inflation expectations unanchoring and a subsequent sell-off at the long end. So I think the fear that policy independence is being eroded has driven a lot of the market moves we've seen so far this year.
So, Michael, interpret this for us. Right now, we're looking at the 30-year. It's at 4.95. We highlighted it earlier, highest level since 2007. Is that bond investors reacting to this idea that Jay Powell could potentially be moved?
I think it is. I mean, it's clearly a very low probability outcome, but it's an outcome that we've got to price in a risk of. And I think you're seeing market participants do that, particularly with all of this furore over the building renovations. That seems like a pretty overt ploy to try and force Powell out through the back door and get another man in as Fed chair.
All right, I want to go back to the market impact of some of this. So let's say hypothetically, Jay Powell is moved. You see a sell-off when it comes to the dollar and also a sell-off when it comes to the bonds. What does that mean for the markets? Last week we had an FX strategist on, and they said basically the declines in the dollar and some of these tariff moves are just making people buy less things in dollars, which has less dollars in circulation, which means less dollars are being spent in the U.S. markets. Do you see a similar setup?
Yeah, I think you're right. I mean, I think really what we're talking about is a confidence issue. You know, if we see policy independence being eroded, that erodes confidence in the U.S. economy and in the value of the dollar. I think the equity market reaction is a more difficult one to judge, though. You would naturally see a knee-jerk move lower, but there's probably a case for dip buyers to step in on that much looser monetary policy outlook once the initial sell-off has been somewhat exhausted.
Yeah, let's pull on that thread for a bit. So let's say, Jay Powell was removed. The thought would be it would be somebody that Trump picks, and they would be considerably more dovish and more likely to cut, maybe even more than 2 times. So would that be a tailwind for the market?
Well, I think it probably would in the short term, although, of course, you've got to remember the dynamics on the FOMC. The chair can propose a decision, but whether or not the remainder of the board and the regional presidents vote in favor of that decision is another matter entirely. So you could very well end up with a situation where whoever Trump picks to be Fed chair, whether that be immediately or in May of 2026, is proposing actions that don't actually carry the support of a majority of FOMC members. So while you'd immediately go, new Fed chair means a more dovish policy outlook, things are somewhat more complicated than that.